Ladies and gentlemen, thank you and welcome back after that lunch break. We will know, as we are already in the afternoon running a little bit late, but we are very close to the perfect timing. We're going to start the fourth session, which title is Climate Risk and Natural Catastrophes, Closing the Protection Gap. Remember to refresh your app so you will be able, to participate to the polling questions. There are going to be 6 for the next session. And let me introduce you to the moderator that you most know already. Jeff Summerhayes, Executive Board Member, Australian Prudential Regulation Authority, Chair, Sustainable Insurance Forum, Member, Executive Committee. Warm welcome to Jeff. He will introduce you the panelists. Thank you.
Thanks, Gabriel, and good afternoon, everybody. Welcome back. It's my great pleasure to host this afternoon's session, and I do so in my capacity as the IAIS EXCO Sustainability Champion, and also, as you heard, the Chair of the Sustainable Insurance Forum. I'm joined, thankfully, by a fabulous panel, which I'm going to welcome onto the stage now, and I'll then introduce them in a little more detail when they come up to talk. But we firstly have Francis Bouchard from Zurich. So Francis, please join us. Thank you. Joining is also Ginger Turner from Swiss Re. Ginger, thank you for being with us. Peter Braumüller, who is, of course, from the Austrian Financial Authority, but also is today appearing in his capacity of Chair of the Access to Insurance Initiative. David Rule from the Bank of England. David, thank you for being here. And Olive Slijpen from the Dutch Central Bank, DNB. Welcome to our panel. So some brief comments from me to set the scene before inviting each of the panellists to present to you, and then we will have some time for questions at the end and do some polling on the way through. As you know, the IAIS is a membership-based organisation with members from over 200 jurisdictions. And as an organisation, we represent many different types of markets and levels of maturity as it relates to insurance. Our mission as an organisation is to promote and maintain fair, safe and stable insurance markets for the benefit of protection of policyholders and to contribute to global financial stability. In the last 35 years, there have been some 17,000 registered natural loss events globally. Insurance has played a fundamental and critical role in restoring communities right around the world and providing some stability and resilience to policyholders from such events. But unfortunately, the coverage of insurance is not universal. The protection gap from uninsured losses on an annual basis is estimated to be about $160 billion US. And according to a recent report by Lloyd's, most of that uninsured loss falls in emerging and developing economies, in excess of 90% of that loss. In fact, the average insurance penetration rates in emerging markets is half that of developed economies. When you overlay the impact of climate change, the outlook for insurance coverage in some of those markets is even more challenging. This is the reason why the IAIS, in its refreshed strategic plan, which is close to finalisation at the moment, called our Strategic Plan and Financial Outlook document, is considering a whole category of new emerged and accelerating risks like climate change, but also, as we've heard earlier today, fintech, cyber, and the session after this is on culture. So our plan is making a deliberate tilt, or pivot, as our chair has called it, towards these new emerged, and in some cases accelerating risks. And our plan states that understanding, assessing and addressing the impact of risks such as climate change is fundamental to the association and our effort going forward, and the unique role that insurance plays in both underwriting and transition risks and managing those risks, and also the opportunities that flow from a changing climate. We have in this last year, in 2018, we think produced some real leadership material on this issue with the IAIS Sustainable Insurance Forum issues paper on climate change risk and its impact on the insurance sector. That report was released in the middle of this year, and we are currently working on outreach to support capacity building within our member jurisdictions, and indeed the Sustainable Insurance Forum that partnered with the IAS is meeting here in Luxembourg tomorrow to further that effort. Our goals for the association going forward, at least one of them, addresses the topic that we are going to discuss this afternoon, and that is that the IAS will increase its focus on helping members to proactively respond to a range of emerging risks and trends and the developments such as climate risk and sustainable development. These issues will be addressed through the cycle of monitoring, standard setting where appropriate, and support for good supervisory practices. So it was with this in mind that we are excited about this afternoon's panel and the issues that flow from the protection gap, where that protection gap falls, and the impact of climate change. Before handing over to Francis, who will be the first of our presenters, as has been the case with other sessions this morning, we're going to ask you a polling question on the way through and ask you to, sense the temperature in the room. The first question up for voting is, will the impact of climate change on the protection gap, what will be the impact of climate change on the protection gap? Answer 1, no change. 2, an increase, and 3, a significant increase. So looks like the view is that it will have some increase, as one would expect. Some believe significant. Not too many in the audience think it won't have any impact at all. So it sounds like we are focused in the right spot with the topic for this afternoon. So without any further ado, I will introduce Francis Bouchard, who is from Zurich, and he is going to open up the session with an insurer's perspective. We will then hear from a reinsurer, then from Peter, who will represent the access to insurance and the emerging developing markets, and finish with 2 supervisory responses. Francis, welcome.
Thank you, Jeff. And I guess I want to start by congratulating Jonathan, Jeff, the entire IAIS for really seeing that the role of the insurance sector is starting to be taken much more seriously. And I think the title here, not so much this title, but maybe that title, Reimagining Insurance, it sounds ambitious, it sounds bold, but I actually think it's happening. And I think if you look around for the last few years, and you see the type of engagement that government is having with the insurance sector, it's very different than it was 5 or 10 years ago. 10 years ago, that sign may have said, "We're not banks." And we defined ourselves by what we were not. And I think today, the engagement that government is having, the dialogue, the recognition of the role that insurance can play in addressing some of these societal issues is at a point where I've never seen it before. And I've been coming to these meetings for 30 years, and I think the constructive, open embrace of the insurance mechanism to address some of these societal issues is something we need to step up, we need to understand, we need to be part of. And if you look back, just over the last 3 years, there's a whole series of initiatives that have occurred that I think kind of reflect or manifest this new spirit. Starting in 2015, the Sundai Framework, and even the public-private partnerships that came out of Sundai. The Paris Accord, as everyone knows, a lot of insurance companies were participating there. A lot of companies signed on to change some of their own practices coming out of the Paris Accord. The SDGs and how they've helped focus not just insurance companies, but the economic players and how they can have an impact. The World Humanitarian Summit in 2016 focused on insurance. Again, this is a community that probably hadn't spent a lot of time understanding the insurance mechanism, and the entire conference was built around it in 2016. The G7 Insurance Resilience Initiative in 2017 that was launched really as a reflection of some of the commitments that were made and earlier under the Merkel presidency of the G7, and how that has now evolved into a G20 initiative that's engaging with the V20, the vulnerable 20. These are meaningful platforms, not just for dialogue, but for action, and they didn't exist just a few years back. For many of us who were in the room who were in Berlin a few months back, I mean, the consensus that was emerging among the government officials, the supervisors, the private sector officials, not just about insurance products and risk transfer, about mitigation and prevention and the need, that also was kind of a reinforcing of the commonality of our sentiment. And I don't know if Juan Pazzo's still in the room, but for anybody who was in Bariloche to see the G20 embrace the insurance sector and having a role in economic development, in sustainable development, in food safety, essentially, I'll quote my friend Rowan Douglas, we're at a tipping point, and government is expecting us to step up and step in. And I would say that I think the insurance industry is doing that. Again, if you look at some of the activities the industry has undertaken and led in about the last same 2 or 3 years, it really shows that we're embracing, I think, this broader role we can have beyond our own P&Ls, beyond our own market strategies, and really understand that insurance has a deep societal and economic role to play. It was referenced earlier today in the earlier session about the Insurance Development Forum. For those of you who are not part of the Insurance Development Forum, I would encourage you to get a better understanding of what they're about, what they're doing. They've just hired a very high energy, highly skilled executive director who I think will take the activity and the impact even further. But essentially, to me, the IDF is probably the most ambitious cross-industry initiative that I've seen in my time in the insurance sector in terms of really trying to have an impact on society, really trying to change the world around us. And I think it says here that I'm here representing the American Insurance Association. This is where I'm going to go in and say nice things about my competitors, but since I have a board member here, I wanted to make clear that this is on behalf of the AIA, not Zurich. I mean, look at the creativity coming out of the insurance sector with the Swiss Re product on the Mexican reef. Look at what XL has done on the blue carbon credits. Look at what Lloyd's, and I think it was referenced maybe even by Jeff, some of their recent research they've done about new financial instruments. Hiscox has had a recent effort around InsurTech and how that can be relevant here. The Geneva Association has done not just cutting-edge research, which you'd expect of the Geneva Association, but they're bringing public-private partner entities together to kind of look at how can we work even better together? How can we actually get impact-oriented and measure the impact, not just dialogue-oriented? The ClimateWise in the UK has partnered with the Cambridge Institute for Sustainability Leadership and really looking at not only what the insurance sector can do, but what the insurance supervisors can do as well. Zurich, my own company, has relaunched or re-extended a 5-year program focused on flood resilience, not from a product perspective, but from a mitigation perspective, where we bring expertise and knowledge about the risk and the options of the risk to communities around the world. I mean, the insurance industry is taking a very different view of the protection gap. I think there was a day not too long ago when we would wake up and we'd read about a terrible typhoon or a flood in the Philippines or in Bangladesh or somewhere, and would say, whew, at least that wasn't insured. Those days are done. And again, to quote someone at Bariloche, Mike McGavick, I think, put it eloquently, I'm not sure, but certainly directly, and that's grotesque. You know, the size of the protection gap with the capabilities that the insurance industry represents and can bring to the table, the fact that that gap exists is morally unacceptable. So I think the insurance industry is really actively engaged, I think in a way that really hasn't happened before, and I think it's fantastic to see the supervisory community not just acknowledge that and recognize it, but actually partner, and that's what it's going to take, because this will not happen with one sector alone. This isn't about only facilitating more insurance products in the marketplace, though. You know, in order to get to that place, the amount of data, the amount of modeling, the amount of mapping, the deeper understanding of the actual exposure that needs to happen in order to actually develop the ultimate risk transfer product, in some ways, that's the societal benefit. And that's where the partnership needs to happen, not just on the product side, but on the deeper tools that are really reflected in what the insurance mechanism is. We had a brief discussion earlier, for the supervisors in the room whose legislative or policy mandate is limited to financial stability issues. I'd suggest to you that there's a financial stability component to all this as well, and I think it was captured extremely well in a Bank of International Settlements BIS study in 2012, I think it was, that looked at the GDP impact of natural disasters. They looked at about 2,500 events in about 200 countries, and they found that when insurance penetration is low, and again, for me, insurance penetration doesn't mean just how many people are buying insurance, but how prevalent are insurance principles in that society. Where penetration is low, you had a pretty dramatic immediate impact on GDP, negative impact on GDP, but worst of all, you had a 3 to 5 point drag on GDP for the out years. So this is not just, are people buying insurance or not buying insurance? This is about the economy and the protection gap impact on your economy. Conversely, those countries that had higher penetration rates, you actually saw a bit of a bump in GDP because of the recovery that went into the economy. So again, this isn't just about insurance companies being able to provide products, hopefully at a profitable level. It's about economies being able to withstand shocks. And that's what the protection gap is really all about. In terms of the role of supervisors, I think there are two, I put them in two categories. I think the first one is the pretty standard role, and that is creating and facilitating a regulatory and supervisory environment where insurance companies can provide the services that they provide. In that sense, there are a few basic critical issues that need to be taken into account. One is the free flow of capital. I don't think there's an economy on this planet where there's enough capital in that economy to actually manage all the risks in that economy. So reinsurance restrictions, direct insurance restrictions, new forms of capital restrictions, those really need to be taken into account, because at the end of the day, if we're going to try to pool capital, I can assure you all that capital is not going to come from one market. It's going to be cross-border by nature. The other area, and they touched on it a little bit this morning, and I think Ginger's going to talk about it more, so I'm just going to mention it maybe as a teaser, is to appreciate and understand how distribution is changing. And in order to address the protection gap, it's going to take 100 different things from 100 different entities across your economies, but understand that the new way of distribution is something that may require a bit of a review of the regulatory approach that's taken. I'd say, though, that the second category that I would challenge supervisors to think about their role is as, I guess it goes a little beyond simply setting or establishing that regulatory framework, and it's really to appreciate and understand the role you play as experts in the insurance mechanism, the fundamentals of insurance, the principles of insurance, the role you play in your respective governments in understanding what it is we can bring to these issues. So, I'm going to use a word, and some of you here may be uncomfortable with it, but be advocates. And I don't mean advocates for Zurich. That's not what I'm asking. Be advocates for the principles of insurance, the principles of risk, the principles of diversification, the principles of long-term planning. Think about the roles, bring back from meetings like this, the roles that insurance companies can play in advancing your own national SDGs. Bring back from meetings like this or in discussions with carriers, best practices about how companies are taking it upon themselves to work with communities, to work with NGOs, to work with others to help protect, to solve the protection gap. Think about your role of explaining terms that many of us in this room may find easy or intuitive. Think about telling a population that an event will happen once in 100 years. It's a 1 in 100-year event, right? I'm not going to live to 100, so I think as a rational human, this is irrelevant to me. Talk to me about a 1 in a 50-year event, and then I'll think about it. We all know that that's not the case, right? But how many other people in your governments understand that that's not the case? You have a role to play, I think, in making some of these terms easier to understand and more relevant for policymakers. And the panel before here, there was someone from Global Parametrics. Think about the power of parametrics when it comes to the protection gap. But think about how difficult it is to understand that as a new insurance concept, how difficult it is to understand the basis risk associated. These are things you could be explaining. These are things you could be working with other government agencies to whom these are relevant, because maybe they don't have the background, maybe they don't understand the evolution of parametric tools. Ultimately, I'd urge you to you don't like my challenges, huh? One final thing. Think about risk mitigation. Think about the land use planning, the business code decisions, the development, the infrastructure investment decisions that are being made in your countries, your jurisdictions, and think about how much more powerful they could be if they were taking into account the evolution of the protection gap. So with that, I'll save the rest. I was actually going to say wonderful things about some of the work regulators were doing, but I think I'll hold on to that at this point and try to slip it in later. But thank you.
Thank you, Francis, and we need to keep it moving, so I appreciate that. I appreciate the feedback also that on the work that the IAIS is doing. We're certainly proud of the shift that we've made in these areas, but there's much more to do, and as we transition to Ginger, there is a question to come up now. Should the IAIS and supervisors be more active in helping to close the protection gap? And that is an overwhelming yes. So, Ginger, I invite you to the stage. Ginger Turner from Swiss Re. Reinsurers have, of course, had deep knowledge and understanding on these issues for a long time, with a great body of research, which particularly as it relates to climate change and how that feeds into the protection gap. So, Ginger, over to you. And I will give you a warning after 10 minutes, if that's okay. So, yeah, great.
Yes, he will.
Okay. Oh, perfect. The slides are there. Great. Thank you so much for inviting me. I'm going to talk about the natural catastrophe protection gap. And I'm going to deep dive a bit into the numbers, and then also talk about, from the reinsurer's perspective, what could be the role of regulation in closing the protection gap. Here we have the 50th anniversary banner of Sigma. Many of you probably have seen Swiss Re's Sigma reports, and actually they started in 1968. So this study of natural catastrophe data and how it impacts the economy is actually, more than 50 years old. Some NatCat data goes back 150 years. Obviously, data quality has improved over time, and we're always improving, actually. So I wasn't around 50 years ago, but over the past few years, I've spent quite a lot of time trying to improve the way that we measure the protection gap. So since it's after lunch, I want to do some audience participation and ask you all, if there's anyone who knows what the size of the protection gap is in US dollars. And actually, Jeff just mentioned it in his remarks, the annual expected number. So does anyone want to take a guess? Thank you. That was exactly what Jeff mentioned. And does anyone know what it was in 2017? It was actually larger than that, so I'll flip to the next slide. In 2017, as probably you're well aware, having seen a lot of the news of all the events that happened last year, we had almost $330 billion in total losses, but $193 billion was the measurement of uninsured losses. So that's over half, 57%. In some years, we have even a higher percentage of that that's uninsured. And if we look at how that was distributed across the world, of course, in 2017, it was pretty driven by a lot of the hurricanes that happened in the Atlantic. So it was really concentrated in North America. That's not always the case. Some years we have a big concentration, the largest concentration in Asia, and so it flips back and forth from year to year. But this is what it looked like in 2017. And that's interesting also, maybe reflecting on the importance of protection gap in emerging markets versus in developed markets. We really see both. But what about what it's looked like over the past 50 years since we've been tracking and improving the quality of this data? Has the protection gap been increasing? That's a lot of the question that we get. Is it really increasing? And from what we can see from the historical data, it is. So if we smooth out the volatility, that annual bump up and down from year to year, we see that the 10-year average of economic losses is increasing faster than the 10-year average of insured losses. So that's the difference between those lines, the red line and the blue line. And that's basically the sort of volatility smoothed protection gap that we see growing over time. Now, this is just a historical view, right? And it's based on a set of events, and many statisticians would tell you it's actually not a very long time period, even 50 years, if we're looking at very low probability events that maybe are the 1 in 100 year or the 1 in 1,000 year earthquake or hurricane. So how do we know what it might look like in the future and if it's going to continue to increase? So actually at Swiss Re, of course, we do a lot of catastrophe modeling, and we have models for most of the major markets in the world on earthquake, flood, and windstorm, as well as other models. So we wanted to take a modeled view, and we modeled what the protection gap looks like, actually what the total economic losses of these three major perils, earthquakes, floods, and windstorm, look like on a country-by-country basis. So this, in contrast to the past graph, this is your expected annual losses. So every year, this is about, on average, what we expect to see. And on the left side of the graph, you have the insured portion. So there's that line down the middle where you see the divide. On the right side is the uninsured portion. So if we look at just this graph, country by country, what you really notice, and I think I have the animation there, is that it's concentrated in the biggest economies, right? In terms of absolute numbers. Maybe that's not so much of a surprise, but when we talk about protection gap, a lot of us think of emerging markets, but really the largest absolute gap is in the US and in Japan and China as our biggest markets that are also heavily exposed economically to natural disasters. But if we want to look at this on a GDP basis, of course, emerging markets are highly exposed. So if we see even a major catastrophe in terms of a major hurricane in the US, it doesn't actually affect percentage of GDP that much. But if we see a major earthquake, a major storm in some smaller countries, that can have a huge impact on actually the GDP numbers for that year. And we've seen that in a number of studies. These two graphs show you the modeled, so again, our catastrophe modeled perspective of 1 in 100 year earthquake on the left and 1 in 100 year storm on the right, the loss scenarios. And you can see that smaller countries like Taiwan, Mexico, Hong Kong, Philippines, highly exposed in terms of GDP. So yes, it is very important in emerging markets. And to echo Jeff's comments from earlier, we see, just the percentage of losses that are uninsured in emerging markets is vast, and in some cases even close to total. Okay, so how can we close this vast gap? These numbers are quite daunting. And I think that the main message I want to give here is insurers cannot do it alone. And we've probably all heard a lot of discussions in other forums around the industry about protection gap already. And I just want to highlight a few of the major complexities of closing the gap. It really involves both public-private collaboration, also, as Francis mentioned, increasing access and distribution, improving product design, and then also on the standard side, mitigation obviously plays a major role, but in terms of specific improvements like building codes and zoning. I mean, this is a very controversial topic in many areas, down to the city level, state level. Of course, I'm from the US, so I think from that perspective, but it's incredibly important, and we see in research the impacts that building codes have on improving and reducing the protection gap, reducing the losses in the first place. So of course, as insurers and reinsurers, we want to sell products, but one of the best ways to reduce the protection gap is not to have the losses in the first place. So I want to talk a little bit about, I have 5 points just on the role of regulators, and talk a little bit about some examples that I see in the industry from the reinsurer's perspective. I would say one of the biggest roles, one of the biggest needs is data, actually, for people to continue to see the numbers on the protection gap and also understand the breakdowns. So what does the protection gap mean for me in my country, in my city? What's the biggest risk that I have? How is that broken down across lines of business? And that can help both sides to really, concretely address the issue. Of course, Swiss Re, we continue to do a lot of the research on this, but we need your help as well. And we want to continue to partner with regulators across the world on data sharing. Now, I'd go a little bit farther than this and talk about our collaborations as well on improving technology. So as technology is vastly changing the industry. Swiss Re is doing quite a lot of work with my other hat that I'm doing on connecting tech companies with insurers. And we see so much flurry of activity in the industry, but some of it can be quite disaggregated. So many startup companies, insurtech, and all of that are trying to improve various mechanisms that we can use in SupTech and RegTech and data analytics. But I think one thing that we're already starting to see that we need more of is compact level innovation efforts, so that regulators can also pool together their resources so that there can be clear standards, and so that companies have clear direction. So I've heard, for example, from some regulators that they get frequent requests for meetings with startups, right? And I think this is great to be open to, but regulators, let's be honest, they're not startup coaches. You have plenty of those. But I think that having forums where regulators can jointly share information on upcoming regulation or on the frameworks with various companies, it would be extremely important, particularly on the tech company side, where, to be honest, regulation is the last thing that they're thinking about. It's very specifically on this point, and it was already mentioned earlier, the importance of parametrics. I mean, for me, parametric products may be one of the single most important tools that we have to expand access in the uninsured areas of the world, particularly the heavily uninsured emerging markets. But Swiss Re actually recently did an internal review of all of our experience across the world in co-developing and launching parametric products in different jurisdictions. The review specifically focused on the regulatory process and the regulatory experience. And what I can share from that was, it was vastly different. There's just every single product experience had very different specifications and very different understanding of what parametric is. So I would ask all of you to think about how we can develop better standards, that we can maybe have global standards and global definitions. And I know that IAIS is already working on this and publishing on this topic, which is, I can tell you from our side, very much appreciated, because understanding more concretely what qualifies as proof of loss, what actually will work in a digital form, how can people submit a claim, is what we need to take the next step. All right, I'll try to be faster then. Okay, so maybe to just summarize this point, I think it's important to remember innovation does not equal technology. I really want you to remember that. It's so easy to be excited about new tech that we see in the market, but there's so many other examples of innovation, and I think that's where regulators have a really strong role to see across the market, to see where the gaps are. I wanted to share one story, but maybe I'll save it for the Q&A of actually a place where regulators are taking a role in an innovation area that's not really tech-driven. I think it's important that regulation should not be seen as a barrier. Maybe advocate is a good word in some cases. That's proactive, and it's about protection, but I think it's very much about a conversation, and we try to spread the message in all of our conversations with the industry that we also need to be concrete. That's more on us about specifically what we require, and open to that conversation. And then finally, I want to point out, distribution models are changing, and actually, in a few years, we may have ecosystems where insurance companies are not the main distributors. And I think regulators also need to be thinking forward about these ecosystem models and the partnerships that are emerging all across the world, in China and the US and everywhere, where insurance products no longer have the same face that they used to. So insurance regulators definitely need to kind of remodel that side for the future, and maybe think about regulating the distribution more specifically than regulating the carriers themselves. And that's all my comments, so thank you so much.
Thank you, Ginger. Well done. next question sort of builds on a bit from Ginger's presentation. I know the answer is up there, but the question is not always easy to see on the screen, so let me just read it for you. Do you see the natural catastrophe protection gap as more important in the developed or the emerging economies? And one was developed, and the blue is emerging economies. Although I think, Ginger, you gave quite an interesting perspective on the absolute versus the GDP loss, which maybe we can talk more about in a moment. Our next speaker is Peter Braumüller. Peter is here in his capacity of chair of the A2II, the Access to Insurance Initiative. A2II is a partnership that the IAIS is very proud of. It goes back some way, and it's been a model about how we can collaborate as an association with other expertise to enable us to extend our outreach across our broad membership base. To hear more about that and how it relates to the protection gap and the issue of climate change, Peter, welcome to the podium.
Thank you, Jeff. Great. It was quite a good starting point with this last polling question. Of course, we are dealing with that, and I would like to start just with, I will talk only 2 slides on the protection gap as a starting point, so to just connect to what we have just heard. Then, particularly the role of insurance supervisors in closing the protection gap. We have heard very interesting comments already today. And finally, supervisory support that we provide for supervisors in that respect. Let me start with that, which is thankfully very similar to what Ginger has shown. On the left-hand side, it's about regions, and you clearly see that in emerging Asia, Latin America, the protection gap is exceeding 90% for all major perils. And what is even more driving our work is what we see on the right-hand side. I took this from a recent Geneva Association publication, is the development over the last 3 decades, and there you only divide it, broken down by income groups of countries. So in the low income, low middle income, upper middle income, it's not getting better over the last 3 decades, and that is really something we should change. The only thing in the high income countries, and that means in the total it gets better. That is the connection to, because they have so much volume that the world average gets better. But to be honest, to see the left-hand side is at least what I would say, if not negative, then very challenging to us to do something in that respect. And the second one, what are the causes of this insurance protection gap? Because if we want to go about on closing that, and I'm now speaking very much on the emerging markets, on the developing markets, we need to understand that there are a lot of differences, and we need either to tackle them directly, indirectly, or at least take them into account when we want to develop. Just a few things on affordability. And I put more to the left-hand side, because the left-hand side, again, is the less developed world. And so there it's about affordability, is clear. But that's not only the price of the product, it's how you can get the product. And it is about what is your disposable income. So what is the competition against if you buy insurance? Is that you have lower consumption in your daily life? So the question is really, where do we start from? Of course, awareness. I think supervisors can also play a role there. I will come to that later. Awareness of the risks, but also awareness of the benefits of insurance and coverage. Trust is quite important, because for those people who have not been familiar with insurance, it's very difficult to understand, to give money and then to hope you get payments in the future if the insured loss occurs. And there comes in strong regulation and supervision in that respect. So in order to build up the trust, it's important to give people the chance to see that you really get your payment, you can rely, there's somebody who takes care of the promise in the future. We have cultural issues, of course. In some areas, insurance is not perceived just only with the benefits, but has some societal or religious issues. Then we have transaction cost of the supply. On the supply side now, you also have transaction cost, of course, but there modern technology is very helpful, as we have already heard. And then institutional side, of course, here two issues. The one is that if the informal sector is very strong, then that might make it more difficult to expand the formal sector, the formalized sector, the regulated and supervised sector, which is the intention of the IAIS and all those working here. And the other one is government stepping in for catastrophes and therefore crowding out some of the private initiatives a little bit. If we go to the question, what can now the supervisor have a role in that? And I believe when I was first confronted with the question, I thought there isn't too much role, but I've learned over years that there might be an important role of supervisors and regulators to play, because we need a sound regulatory framework to enable a stable insurance market and protect policyholders. That's all, again, around this trust. And we need regulatory certainty as a success factor. And it's important to not only have a regulation in place, but it's tested. You can touch it. You can really feel that something is going on. Market is developing, but in a positive way. Particularly the role of regulation and supervision. If we look more on the regulatory side, which of course is sometimes difficult to distinguish from the pure supervisory side, there's certainly, you have to think about what is the role of governments and public schemes. I've just touched upon that. Is that encouraging or discouraging the taking up of private insurance business? So we've heard about, Francis has referred to the policymakers already, so it's important to get this overall understanding, because otherwise we will not be able to build up that systems properly. We need the possibility for innovative products. We have heard already in the last panel about index-based insurance as one of the innovative approaches, but also difficult to put in practice, admittedly, but I think it's good to think about solutions that strengthen this affordability of insurance products to the low-income population. The possibilities for innovative distribution, we've heard a lot and the possibilities are there, but of course regulation supervision should allow for that and should really allow to harvest the advantages of that technologies. Still in a regulatory framework which allowing this innovation. Then of course reinsurance availability and capacity. We've seen, if we speak about catastrophe, you might not find solutions for one country and one region if you don't find a way to distribute, and that needs to be respected in reliance certainly on reinsurers abroad, but there are some regional pilots on the way that are quite promising. And finally, foster cooperation of supervisors with governments and other supervisors. I just want to refer to the more players we have, this kind of affordability, making product more affordable, cheaper, insurance premium affordable, also means that new players, insurtech, fintech, mobile network come in, and you need to understand how they are regulated, what is the role of their regulators in the whole context. If you look more on the supervisory side, awareness creation and role in education, I think we have heard not everybody has a mandate on that, but I believe in some of the regions we are speaking about, in some of the countries, it is basically the supervisor who is the only one to have really the knowledge about the business, about the risks. So I think they should, in all cases, play a major role, whether or not they have a direct mandate or not. Facilitate the market development through the rules, not hindering them. Build the knowledge and competence in the authority. I will come back to that because this is quite important. Again, on trust, again, on reliance, on a sound and robust system of supervision is that you have sufficient knowledge and competence in the authority and you can keep pace with the market developments, and understand and apply proportionality. Just to reiterate, we have it laid down in the ICPs. The proportionality principle is well known. We didn't want to have a split between two classes of our members. We have one ultimate goal that is laid down in the ICPs, in all our supervisory material, but the supervisor need to tailor certain actions to the nature, scale, and complexity of individual insurers so that they are commensurate with the risk posed. So there is not only an invitation, there is a kind of responsibility to do that in order to achieve the outcome we want. And finally, the role in this respect of the A2I is as the implementation partner of the IAIS to strengthen the capacity and understanding of supervisors. And we say to facilitate, because not everybody is to promote directly, but at least to facilitate in all they are doing the promotion of inclusive and responsible insurance, thereby reducing vulnerability, and I mean also thereby closing the protection gap. In the order of time, I come to my last slide, which is about some of the things we do directly related to the topic here. The first thing is that climate and disaster risk insurance will be the yearly topic for next year, so it's quite timely to speak here about that. That will be our main focus, besides many, many activities, but that has turned out to be really in the heart of the need of most supervisors. We plan 3 consultative fora on that, and a study on the regulatory barriers to climate and disaster risk insurance. As we have heard, there shouldn't be barriers, so we need to understand what is perceived to be a barrier, even if it's not a barrier, or if it's a real barrier or not. And then I'm very proud that we have concluded this agreement between the IAA, IAIS, and A2I on enhancing actuarial skills to insurance supervisors. We might understand that when there are simple products in the area of natural disasters, there is a need for having a sound understanding in the supervisors of the underlying techniques of that. So we will foster the understanding of the fundamentals of catastrophe insurance and develop a delivery of society capacity building training programs. It is not to educate actuaries, it is on a proportionate way to try to get all the supervisors the necessary level of actuarial skills and knowledge to understand those products, which will again help to have a more open mind on letting those products really grow in the market. Thank you very much for your attention.
Thank you, Peter, and thank you for the great work that A2II does in market development and capacity building in developed and emerging economies. Peter gave you a range of thoughts there about initiatives that could make a difference, and our next polling question is to, in fact, test your reaction to those. So the question was, just to recap, in your view, what would be the best help to narrow the gap? More than one response was permitted as it related to the protection gap. So better products, table to low income, 34%. Raising awareness of the need for coverage, 40%. And Peter and Ginger, technology didn't poll so well, but as you said, technology in itself is not a solution. So, and then finally, trust in insurance, 14%, always helpful. So our next speaker is David Rule, who's the Director of Supervision for Insurance at the Bank of England. The Bank of England, of course, and the PRA have been at the forefront of raising awareness on climate risks as it relates to the financial services sector. And more recently, the bank has, I think as they have termed it, David, made a transition in thinking, or at least projecting a transition in thinking for the industry. So to hear more about that and the Bank of England's considerable effort in this space, please make David Rule welcome.
Thank you, Jeff, and it's great to be here. So I'm going to talk about 2 examples of action on the protection gap today. I'm going to talk about Flood Ray, which is a particular UK initiative on flood. And I'm also going to talk about the Centre for Global Disaster Protection, which is a new initiative that's been founded by the UK government and the World Bank. But first of all, as Jeff said, I'm actually going to go off topic and talk just briefly about what the work the bank has done on climate change. And I know you've had a session on this already, so I'm not going to dwell on these first slides. But sufficient to say that we've been looking at exposure of banks and insurers to climate change over the past couple of years. And our analysis is that the exposure comes through 2 main channels: the transition risk channel, which is how society and governments adapt to low carbon, the need for a more low carbon economy, and what effect that has on balance sheets, and the physical risk challenge, which is the more familiar direct exposure. And obviously the physical risk challenge is very directly relevant to the protection gap, because as I think was reflected in the poll earlier, it seems likely to me that the physical risk changes with climate change are going to make the protection gap even more difficult. So this chart just kind of shows how we think it all fits together. The physical risks come from the carbon in the atmosphere. Those create financial risks, also the transition risks, and an orderly change will minimize the financial risk, but nonetheless there are risks either way, because if you reduce the, you will get more transition risk if you take more action to address climate change. So Jeff mentioned the publication we recently put out. So this is across banks and insurers. And the real message of our publication is that we need to move climate change from being a corporate and social responsibility issue to also being a financial risk issue for firms. And that's why we see it very much in our mandate as prudential regulators and supervisors to take action on this. And the action that we're proposing is largely in that direction. It's to make sure that our firms are thinking about this as a risk issue to them. And so what we've asked them to do is to embed the financial risks from climate change in their governance arrangements. We've asked for one senior manager to be made accountable for the actions that the firm is taking to address risks from climate change. We're asking for financial risks from climate change to be integrated into existing risk management practice. We're asking firms to use long-term scenario analysis to think about what the implications for their business are and what the risks are. And indeed, we ourselves are thinking about our own stress testing and whether we can use scenario analysis, not in a kind of, probably not in a quantitative way like a classic stress test, but more in an exploratory way to look across the industry at the impact of climate change. And then finally, we're asking firms to develop their approach to disclosure. We don't want to be too prescriptive about how they do that at this stage, and obviously there are the wider disclosure recommendations, but we do think that more needs to be done by firms in that area. So we're consulting on that, and that consultation period will end on the 15th of January next year. So flipping back to the protection gap, I think they are related, but that's a bit off topic. So the first thing I'm going to mention is flood rays. So this is a domestic initiative, and I think it's interesting mainly because it's an example of a public-private and also supervisor partnership to find a solution to an emerging protection gap in the UK for flood risk. So flood rate was established by legislation, but it was really a collaboration with the insurance industry with the purpose of allowing for provision of affordable flood insurance, including for people in floodplains. So flood rate is a mutual commercial entity. It's owned and managed by industry and operating independent from the government. It's regulated by us under the same, under Solvency II as any other insurer. The way that it works is that it levies all insurers that are in the home insurance market to give itself a baseline of capital. And then there are fixed fees for insurers to buy reinsurance from flood ray against flood risk on their household policies. So where they want to, they can go to flood re and purchase reinsurance against that flood risk, and then pass that cost on to the customer, so that the customer effectively has a ceiling on the cost of its of his or her household flood insurance policy. So 150,000 households have benefited from that. That's actually a bit less than they were expecting, mainly because the market has actually been pretty soft and competitive, so insurers have actually been wanting to take some of this risk, maybe more than they were expecting. But Flood Re is actually going to be reducing its premium rates next year, so it may get a bit more of the risk. So Flood Re is a transitional scheme. It's really a sort of mutualization of the risk. If it experiences a real CAT event, it also has the ability to levy for higher contributions from insurers. And the quid pro quo is more investment in flood protection. And so Flood Re is time limited. It's planned to end in 2039, with the expectation that by then there would have been the investment in flood protection measures. So I mentioned that as a particular example. I'm now going to flip to another UK initiative. So this is not a Bank of England initiative. It's an initiative by the UK government working together with the World Bank, but it is a UK-based organization. I think it's not yet got its executive, but it will, I think, soon be operating. And it's really working in this area of encouraging innovative ways of putting insurance and financing together to both encourage investment in resilient infrastructure, so to reduce the loss in the event of disasters, and also insurance payouts, and with the focus on how can we get quick insurance payouts. So what the previous discussion around parametric approaches is very relevant there. So there was a recent publication, which I think Jeff might have mentioned, by Lloyd's, which is very much working with this new centre, that mentions some ideas for some of these financing solutions, and I've got some of them listed here. So the idea of the centre is that it will bring together, I guess, donor organisations that provide aid with the London insurance market to try to find innovative ways of improving resilience against these disasters. And I'll just show you a couple of charts. So I've had a lot of charts, but here's a couple more. So this one is focusing on this question of models. So in order to provide insurance cover, I think essentially you need models. So this is just showing, I guess, commercially available models. So not maybe in-house models that insurers may have, but it just shows that there is just a much big difference between advanced economies and emerging economies to the extent that there are available CAT models, and this is across all different types of CAT, whether it be earthquakes, storms, etc. So what we need is more models for emerging economies. And then this is a chart from that Lloyd's publication, and it shows some examples of the value of investing in prevention, I guess, so in resilience. So if you want to find it, it's on their website, so you don't need to take pictures. So it's just an example of how if you invest in resilience, you get a big dividend, and this just shows their estimation of the cost-benefit ratio of some of these investments. So this centre is very much focusing on the two sides, making economies more resilient, and then using insurance to create resources quickly if disasters happen. Okay, thank you very much.
Thank you, David. If we could go to our next polling question, which is, of the three roles that insurance performs, risk transfer, investment, and risk signalling, which do you think is the most important in closing the protection gap? And overwhelmingly, that is 62% on risk transfer. I think Andy Jobst, who was here from the World Bank, will be disappointed in the 4.2% on investment, having made the case for infrastructure investment in the previous session, but perhaps that's a maturity issue. And I'm pleased to see risk signalling at 33% there. I think that is often a underrated dimension of us as a sector. We have a lot of intelligence, and that intelligence we don't always share for the broader good, and certainly risk signalling across to the banking sector and to communities more generally is a great opportunity, I think, for the insurance sector. So David's counterpart at the DNB is Olive Slypen, who is also in charge of insurance supervision, amongst other roles at the DNB. They have also been at the forefront of much of the thinking around climate change, and along with the Bank of England are also two foundation and very active members of the Sustainable Insurance Forum, which has led to a lot of the good work that has been feeding into the IAIS, and particularly the issues paper that I mentioned earlier. So, Olive, very good to have you here, and we look forward to hearing what you've got to say. Thank you.
Thank you very much, Jeff, and thank you also to the IAIS for inviting me here today. Indeed, if you are the last speaker in a panel, there is bound to be some kind of overlap, and maybe that's also good news actually. And indeed, there will be quite some overlap, and again, in the category good news, with indeed, you introduced him as my counterpart, David, because indeed, we have been working together a lot also on issues of climate risk and the impact on the financial sector. First, I would also like to say a few words about what the Dutch Central Bank is doing. And secondly, I also would like to kind of talk to you about, let's call it the business case, and that is flood risk in the Netherlands. And I think all of you can relate to that. You all know the story most likely about this little boy putting his finger in the dike. Actually, that's what I will be talking about. First, what are we doing in the area of sustainable finance, climate risk? First of all, we are hosting something which is called the National Platform for Sustainable Finance, bringing together actually financial institutions cross-sectorally and let them share their knowledge and experience. They're also preparing papers on the issue, and we have learned actually that it sounds very trivial, but indeed banking, insurance, pensions, they have a lot of knowledge, but apparently on this issue, but the communication between them was not always that good. So we brought it together. Together with the Bank of England and the PRA, we are a founding member of the Network for Greening the Financial System, a network of central banks and supervisors, and many of you indeed here in the room represent institutions that are already a member, and the membership is still growing. And we have also worked already a couple of years ago on a report on sustainable investment in the Dutch pension sector. I dare say that Dutch pension funds actually have been leading in this area. We also, like the Bank of England, and actually also inspired by the Bank of England, we have produced several reports. Very recent, we actually published our own first climate-related stress test. And last year, and I will come back to that later when I talk about flood risk in the Netherlands, we also published a report called Waterproof on, let's say, the impact of a number of climate-related scenarios on the Dutch economy and on the financial sector. And finally, just like the Bank of England and the PRA, we are also in the process of embedding climate-related risks in our supervisory approach. Now let me turn to flood risk in the Netherlands. This graph, this is a map of the Netherlands, and it shows you the risk of damage caused by flood. The areas that are white, there the risk is extremely small. The areas that are green, the risk is somewhat larger, but maybe surprisingly to a lot of you, the risks are actually largest, not so much in the coastal area, but let's say in the areas, the river delta. As you know, the Netherlands basically is a delta where a lot of large rivers in Europe come together. So that's the area which is kind of yellowish, reddish. So the left map shows you the risks as they are currently estimated, and here we are talking about damages. I think damages per household per year. And then the next one, which is more green in a way and white, those are the risks in 2050, because actually the Dutch government has embarked on a lot of measures to reduce the probability of flooding, in particular in those areas where the rivers are. Still, the risk is quite substantial. As some of you may know, the Netherlands had a catastrophic flooding in 1953, cost the life of 1,836 people. That was also the beginning of, let's say, the improvement in the infrastructure. And ever since, there was also this idea, but this is a kind of risk that cannot be insured, at least cannot be insured by insurance companies. So the action that was taken by the government in those days was to agree upon, let's say, a special crisis law, and to say if a disaster like this would happen again, it would be up to the government to finance those losses. But there is no ex-ante pre-funded fund. That also means that if you look at the market for flood risk in the Netherlands, it is very limited. There is some flood risk incorporated in, let's say, certain products like homeowner insurance or car insurance, but for disasters like this, it doesn't exist. Rather recently, Dutch insurance undertakings have stepped up and said we have to do something in this area, but indeed, like Ginger was saying, the protection gap might actually be quite large in developed countries. I think this is a very good example where this is the case. There is the protection gap in a way is covered by the government, but what amount you will get, whether you will get an amount, you don't know ex ante. That is definitely an issue. In our waterproof report, we also run a number of scenarios, in particular in those, let's say, areas where the large rivers are. What would happen in case of a major breakthrough of the dikes? And in one scenario, and that's actually, if you look at the map of the Netherlands, that's the lower yellow-red region. There we done some computations. Actually, we didn't do it on ourselves. We used the knowledge of a research institute, and we came to the conclusion that then the total cost for the economy would be 60 billion euros, and the credit losses for financial institutions and also for the government would be around 2 billion. If dikes would break through in, let's say, the yellow area, which is a little bit more to the north, we're talking about total losses of 20 billion and credit losses, including credit losses for the government, like government bonds, of about 1 billion. So we're talking about real big numbers. So what to do? First of all, we very much welcome all kinds of initiatives to develop this market. And although closing the protection gap is not, let's say, in the mandate of the Dutch Central Bank, what is in our mandate is supervising the business models of insurance companies. And we do feel that insurance companies should also be forward-looking, and that also includes if new market opportunities arise, it's good that they kind of take the initiative. What we also found out, indeed, and it was already mentioned basically, and that's exactly what happened in the UK, but also in other countries, that when you talk about cover structures like this one, the one in the Netherlands, you probably need a public-private partnership. First of all, if you look at the risks themselves, you saw it yourself on the map, the risks are skewed, they're geographically skewed. If you live in certain parts of the country, I mean, I was born in the southern part of the country, in Maastricht, the risks are very small. But how do you deal with that? But also there will always be some residual risk, which most likely needs to be covered by the government. So all these structures probably need public-private partnerships. And then indeed, and it was already mentioned, the use of the reinsurance industry is extremely important, let's say, in helping these initiatives fly. So, indeed, I just want to firmly subscribe what was said when we're talking about protection gap. It's not only the case in emerging markets, even in a country like the Netherlands, which is a highly developed country, when it comes to the flood risk, there really is still a lot to be done. Thank you very much.
Yes, they work. No switch for on, so we're ready to go. Our last question before seating the panel with some views was to do with which peril has the highest protection gap globally in terms of absolute value, and maybe Ginger can assess whether we've got the right answer here or not from the audience. I thought it was earthquake, so earthquake came in at number 2. Olive would be, flood would certainly be the case in the Netherlands, Olive. Windstorms at 16%, earthquake at 36%. But Ginger, how big is that difference? How big is earthquake in a relative sense?
Is this on?
Yes.
Oh yeah, perfect, okay. No, so earthquake is quite a lot bigger, and I don't have the slide up anymore that I showed earlier, but if you go back to that slide that really has the bars of each of the countries, you can see there's quite a lot of variety. So it really depends on where you are. And I think Olaf made an excellent point there, that geographic diversity is so important, and that's actually really difficult to deal with in an actuarial sense. I think that when we have these risk pools, as we typically do in the insurance industry, you have to mix together regions that aren't exposed, regions that are. So in answer to your question, I mean, earthquake is incredibly important, but has very specific hotspots. Like in the US, we have California earthquake. But regulators there have had to step in at various points and support the mechanism for that, because we don't have earthquake exposure in other areas. So where it's important, it's very important, and where it's not, it's not.
Francis?
Jeff, I think there's another way to look at this as well. It's not so much by peril, but the Geneva Association did an interesting report and looked at the protection gap globally. The Nat Cat protection gap globally was 0.2% of global GDP. The cyber insurance gap globally was 0.5% GDP. The healthcare gap, and I think it was referenced by a questioner earlier, was 2% of global GDP. So protection gaps go well beyond Nat Cat, and I think for the insurance industry to truly play its role in society, we've got to look at those gaps as well. We've got to work together, not just on Nat Cat, but the others as well.
Yeah, I saw an Aon report the other day which highlighted the biggest risks to executives, 10 biggest risks, and most of them are risks that there isn't currently insurance coverage for. But we need to stick to the topic, which is the protection gap, and as it relates to climate risk. I want to go to you, David, on this transition in thinking and the role that regulators play, where there has been a period of, I guess, awareness raising to now at least the PRA and others are flagging more active supervision of climate risk as it relates to whether the protection gap being in developed economies or developing economies. How do you see those next steps playing out?
Yeah, I think we're learning. I mean, we don't know quite what we need to do as supervisors, nor do the firms know necessarily all that they need to do in order to protect themselves against the risks from climate change. I mean, one of the insights we've got from our meetings with firms, I guess, is that this kind of gets you one way or the other. There's no way of avoiding it, because either you're going to be, either society will do a really good job of moving to a lower carbon economy, in which case we'll get very big transition risks. And sometimes those are not quite what you would expect. So one of the ones that we uncovered was as government puts in requirements for houses to be better insulated and more efficient, those that aren't, actually the house prices may fall, or they may become more difficult to rent, and that will then affect banks that have mortgages against those homes. So some of those risks are not the obvious ones of I've got a share in a big oil company, I mean, or a coal mine. That they need some thought. But equally, as cynics like me think is probably more likely, if we don't do enough, then there will be very significant direct physical risks. And for insurers and insurance supervisors, I mean, one obvious point there is that most models are based on history, and as we go forward, history is going to be a less reliable guide to risk in some of these areas, and we need to ensure that companies are thinking about that. But obviously, to some extent, it becomes more unknowable. I mean, you have more pure uncertainty and less risk.
I think you flagged, and I want to go to you, Ginger, you flagged, David, in one of your slides about this issue of models and understanding scenario planning, and Ginger, you touched on data and taxonomy is a huge issue with modelling. What can be done, particularly for developing and emerging economies in this area, just the understanding of the risk, which one would expect is more evolved in developed markets?
That's a great question. I was also making notes and thinking about what we can do, because obviously we have quite good models for the areas where insurers are most active, so for the biggest insurance markets. Now, for modeling very tiny countries or countries that really don't have much insurance coverage, I would say from the industry side, we don't necessarily have the resources or the capabilities to do that. The data quality is often not necessarily accessible to us, but obviously the monetary incentive, unfortunately, we don't have people devoted to those countries. So I think that collaboration there is a huge area of opportunity where we can share our expertise on modeling and maybe get better data quality from some of the regulators or entities in those jurisdictions.
Peter, is this something that A2II is looking at?
Yeah, I think that's exactly what Ginger right now said. It's important to put forces together, because to understand, we need simple solutions there, but we need good solutions and technically sound solutions still. So to build upon what is there and to find, with some simplifications, to find possibilities to make it work for. I think positively about having that, because there is so much knowledge and so much experience already there from big companies. It's really about, but they also need to do it in a sound way, with a sound risk management, a sound pricing. That's for sure, because otherwise, that's why we educate regulators and supervisors, that they should not allow those entering the markets that have not the expertise. But those having the expertise, there should be collaboration between the supervisors, and also particularly on the data issue, I think. Thank you.
Olaf, you touched on between the different sectors, how there isn't as much information sharing or knowledge that goes, for example, at its highest level between the insurance sector and the banking sector on understanding these risks. I know NGFS is looking at that issue, but should we be surprised that we are so across different financial sectors that there isn't more sharing of information, and what can be done to change that?
I'm not sure whether we should be surprised. To be quite frank, even in the supervisory community, their banking supervisors and insurance supervisors quite often operate in silos. So it happens in the industry as well. But for instance, in the Netherlands, as I said in my introduction, in particular, the pension funds in the Netherlands have been leading this work, also in look at the criteria, in particular the ESG investments, as it's called, as you are aware, particular what are the criteria we should look at, but also what are the risks, etc. They've done a lot of work, and although that work can almost one-on-one be shared with insurance companies, and although one cannot completely immediately transpose it to banks, but still there's a lot of information there. Also bringing together analyses like this. I mean, insurance companies, they're very, very good in assessing the physical risks. But that also helps the banks, because it also affects the banking sector. If there's a flood, what will happen with mortgages and the repayment of mortgages? So this kind of linkages, it's very good, and that's why we created this platform, and we're basically only the facilitator. And so there are representatives from all the institutions working on several topics, and it works very well.
Can I
Please.
echo something there? And actually congratulate you for that, because one of the earlier questions asked about the role of the insurance sector in this, and price signals was not the first one, but the second one. But price signals that we can send through a 12-month insurance policy is pretty weak. Unless a risk we know is going to evolve over 12 months. The risk signals that a pension fund who's about to invest in something for 30 years, or an insurance company that's about to invest in 30 years, or a credit agency, or a mortgage provider, or whatnot, they can send longer-term or signals about longer-term risk. So I think bringing these different signal-sending functions that the financial sector do together, as you're trying to do here, I think is very powerful, because I do think that there is sometimes an overestimation of the clarity of the price signal that the insurance mechanism can send. And I think it's a function of our predominantly 12-month policies. So I think bringing the mid and longer-term financial instruments that also send price signals is a great thing to do.
How different would that be if there was multi-year pricing, which there is in reinsurance, for example?
Yeah, I mean, I think the reinsurers are much more comfortable with it.
Yes, so great question, and I think we're very cognizant of that as well. I echo your point. There are some multi-year reinsurance contracts, but vast majority are still one-year insurance contracts. So, reinsurers think quite a lot about the long term, but it's not necessarily reflected in pricing when we think about really long-term issues.
Surely, though, Francis, this hiding behind a one-year contract is a cop-out, isn't it? So, for us as a sector, it's the boiling frog syndrome, isn't it? Is the point that data looking backwards says something, but it doesn't, with this particular risk, doesn't predict the future as well as some more linear risks.
I agree with you completely. I don't think it's a cop-out. I think it's an economic reality. But I do think the insurance industry is taking the lead in trying to say, let's not just look at the 12-month insurance, the risk transfer mechanism alone as the mechanism to address this, which is why I think most of the innovative, progressive type of insurance initiatives that are out there are not looking at pricing 12-month policies better. They're looking at creating new partnerships, bring new people in. Let's look at mitigation. The numbers there were pretty remarkable about, $1 of mitigation equals X of less loss, right? I think gaining awareness around that whole ecosystem is the point I was trying to make about insurance principles, not just insurance products, but insurance principles. The more we can bring those into every aspect of government policymaking and economic activity, and then reflect insurance principles in those other activities, the less reliance there is on a 12-month price signal.
Oliver and I were at a forum for the World Bank last month, and there was a view put about climate risk and the protection gap being a huge put option back to governments all around the world, and ultimately governments have a very poor handle on what this put option is. What's your view on that?
I don't think it's an unfair characterization. I'd say when you look at a risk that is multi-generational, that is cross-border, that is a reflection of industrial policy perhaps for the last, 150 years perhaps, it's really difficult to make short-term policy/political decisions in an environment that is so wildly complex. So if you're a policy in one country and you're trying to solve it in your one country, you can't solve it in your one country, right? There's so much of the prisoner's dilemma going on here on these policy issues. So I don't think it's unfair to call it, the ultimate put option, but I think it's probably the most complex policy challenge, that government has faced, and candidly that the insurance industry has ever faced. And again, I think we got to, and I think Ginger put it well, that it's going to take collaboration across all the entities to help make that put option manageable.
David, on the point of collaboration and flood re in the UK, did I see in your slide, and you mentioned it, there was a sunset on that arrangement to 2039? Was that the year? Can you just explain a bit more about that?
It's when it stops raining.
So my understanding is that this was part of the deal between the industry and the government, that the industry was prepared to mutualize this risk, but not on a permanent basis, that there would be investment in flood prevention. Now, add climate change to the mixture, and that becomes a bit more challenging, I think, and it was interesting what they're doing in the Netherlands as well. I mean, how resilient that would be to a changing climate is going to be a really big question. But certainly for the time being, I think industry are expecting that investment to happen, and yeah.
Now I'm looking to Gabriel. We started 15 minutes late. I'm assuming we can run 15 minutes over, which is say we had 5 minutes to go. I don't know whether that's correct or not, which if that is the case, before we do close out for afternoon tea, if we can take a couple of questions from the audience. Yes.
Yeah, it's Rowan Douglas of Willis Towers Watson and IDF. It's a great panel. I just want to ask whether the answer to how society deals with the protection gap is actually how we dealt with our climate risk protection gap from the 1990s onwards. So in '92, I entered the industry a month after Hurricane Andrew as a reinsurer, and witnessed graphically our own protection gap, where economic losses that we faced far exceeded our reinsurance protection. And what happened since then was that climate risk, and climate is just patterns of weather. That is what climate risk is. Climate risk was embedded into our industry as an input to credit risk through solvency. And it always amuses me when we say we just use historical data. The lesson we learned in '92 was you can't use historical data. So we used historical data to train CAT models to create scenarios of extremes that we actually probably will not see for the next 100 years. And slowly, we created a reduction of that protection gap. Now we're seeing through the processes such as Olaf mentioned that the wider economy is finally wanting to ask the questions about physical climate risk. But the wider regulatory community, the wider business community, who've basically come through the transition risk journey, have absolutely no idea of the methods and metrics and models that should be used. We have the basis of that modeling framework, which of course needs to be expanded and developed. But the first thing is to look at Ginger's protection gap. She said there's 0.2% of natural catastrophe losses of global GDP, of which 0.3% is probably insured. The first thing is that protection gap has to be disclosed through the regulatory processes using the sort of models we have in banking and asset management. And then, of course, we can begin to project into the future. But the greatest role that the insurance regulatory community could play is to recognize that you're the only regulators in the world who already have undertaken the magic of incorporating climate risk into financial regulation, and share that with your wider partners. Because literally, millions of lives and billions of dollars in the coming decades depend on that. And my question to the panel is the underinsurance protection gap, should that become actually a function and a mandate of our regulatory priorities? But the answer to the protection gap is fundamentally replicating the journey that you all have taken in the last 25 years, and never ever underestimate the intellectual brilliance of what happened, because everyone else is struggling to do it.
Thank you, Rowan. It's a passionate plea. Ginger, you're keen to respond?
Yes, thank you so much for your comment, and also clarifying a bit the comment earlier that we just model based on history. That's actually not true. We're for the past several decades, and I showed the two different versions. Remember, I showed the graph that was over the past 50 years. That's the historical view. But actually the model view, as Rowan said, the protection gap that we measure, it's based on simulation, and that includes also anything we can imagine about what could happen, and we combine that with what we know about experience. So thanks for sort of clarifying that, but I also want to, really make the point that that model is really, our expectation for now. And so you're right that we haven't really fully said as an industry that we're definitely going to incorporate sort of the 100-year climate change model and what it's going to look like into the future, because actually that's not fully our decision. I think the question of whether we ask society to pay now for something that we think might happen if certain adaptations don't occur over the very long period is very much a political question. And also the question of whether we ask certain geographies to pay more than others is a political question. So that's where we need collaboration.
I think I also heard a regulatory challenge in that question, in the provocation.
I certainly heard it.
Yeah. So to my regulatory colleagues at the other end of the panel, Olive, David, Peter.
I mean, I think it was also more like keep on going what you're doing, guys. What I find interesting, I was just thinking about it, that what was said also about insurance regulation, the incorporation or early incorporation in insurance regulation of these kind of issues. In what is it, 2 or 3 weeks from now, there's a similar event will take place, but then for banking supervisors, the International Conference of Banking Supervisors in end of November in Abu Dhabi. And I was thinking, would they also talk so much about climate-related risks and as we are doing? And I think the answer is no. So there, I think, bringing this further, also in the regulatory community, I see that point, and I think it definitely needs to happen.
I think we're going to need to wrap up because there is one more session to go after this. But to your point, and I think, Francis, you made it at the opening, a panel like this would have been unimaginable going back a couple of conferences ago. There is a lot to do on this subject. The IAIS is very focused on it. As I said in my opening, it is very much embedded into our new strategic plan and financial outlook, which we hope to finalise in the new year, along with other emerged accelerating risks that we need to turn our mind to. We've been very busy, of course, with post-crisis reforms, but Rowan, the challenge is heard. I think this sector gets it, but in terms of all participants in the sector, there is a hell of a lot more to do, and there's not a lot of time to do it. So hopefully this afternoon has been useful in that debate. Thank you for your questions. Thank you to the panel for their contributions. Please join me in a round of applause.
Thank you, Jeff. Thank you to all the panelists. Ladies and gentlemen, we're going to do now the last coffee break. I'm very sorry to announce that the coffee break is only going to be 20 minutes rather than 30, so we can get closer to our original timing. But as 75% of you are drinking more espressos than large black coffee, I'm sure it's not going to be an issue. See you in 20 minutes. Thank you.